The decline in value of a computer due to the release of newer, cheaper, faster model is called functional obsolescence. Under the current law, what is the statutory date of appraisal for use items? January 1. Inventory items are January 1 or September 1 if applied for and granted by the chief appraiser. Which is the best definition of use items? Goods that have reached the use for which they were intended. Which is the correct order of the levels of trade? Primary producer, manufacturer, wholesaler, and retailer. Each one of those levels also adds on a little bit of profit as it goes up the chain. Use the retail market method to estimate the cost of inventory. Retail value of the inventory, retail value is $20,000. So that retail is higher than the cost. Markup, though, on top of the cost is 35%. So we're trying to get back to cost. So we're going to take $20,000, divide by 1.35, and we'll come out with $14,815 for the cost of the inventory. Using the following information, what is the value of the inventory? Total purchase amount is $60,000. Total units purchased is 12,000. So divide 60,000 by 12,000, that's $5 per unit, but the units left on hand is 1,100. So you take 1,100 times $5 and you get $5,500. Easy. Which of the following is not a depreciation method in accounting? Replacement cost new less salvage value. This is an accounting question, not a normal depreciation. Straight line depreciation, declining balance, and sum of years digits method are all depreciation method in accounting, I think. But replacement cost new less salvage value is not accounting depreciation. That's the depreciation for the personal property that we're appraising. Appraisal depreciation and accounting depreciation will always be equal. That is a false statement. Do not fall for the trickery. Depreciation is best described as a reduction in loss from all value, a reduction or loss in value from all causes. If the acquisition cost of a piece of equipment is $10,200, the index number for the present year is 820.5. The index number for the year of acquisition is 547. What's the replacement cost new? Well, we follow the same rules as trended historical cost in the cost approach, and we divide the current year by the original year of acquisition index. So 820.5 divided by 547. Then we multiply that by 10,200 and get 15,300 for our replacement cost new. The economic life of an asset refers to the number of years over which an asset is useful. If an asset has an acquisition cost of $5,000 and a salvage value of $500 and an economic life of 10 years, what is the annual depreciation using the straight line method? Well, in the straight line method, each year has the same depreciation amount. So the first thing we got to do, though, is deduct the salvage value from the acquisition cost. So 5,000 minus 500 is 4,500, and then we divide that by the economic life of 10 years, and we get $450 per year of annual depreciation using straight line. True or false? The income approach is a good method to valuing lease equipment. That is true. If the subject's property's fixed assets are 58% good, the amount of depreciation is 42%. There are penalties under the Property Tax Code Section 2228 for taxpayers who fail to render their taxable personal property. That is a true statement. Remember, penalties for failure to render is Tax Code Section 2228. Situs and taxable location is the same thing. True. September 1 is always the appraisal date for inventory according to the tax code. False. Not always. Inventory qualifies for Freeport exemption if it leaves the state in less than 175 days. Furniture, fixtures, and equipment, machinery, and inventory are all examples of tangible personal property. Which property is an example of real property? Well, that would be a mineral interest near Midland, Texas. Consigned goods are always listed in the name of the owner. Of the consigned goods. Personal property discovery is more difficult than real property discovery because personal property is usually movable. A rendition is a form used to report taxable property owned as of January 1 unless the chief appraiser has granted September 1. Which of the following are applicable methods used in personal property valuation? Well, that would be the cost approach, market approach, and income approach. It's not just one. The loss of value in equal increments down to an estimated salvage value is an example of straight-line depreciation. Here's some income. Calculate an estimate of property value given the following information. NOI after taxes is $450,000. Overall rate is 9%. Well, we have the effective tax rate of $3. I say you don't add in the tax rate because it's after taxes already. So 450,000 divided by 9%, that'll equal $5 million. Let me double check it. $450,000 divided by 0.09 equals $5 million. I was correct. NOI is after taxes. Calculate an estimate property value given the following information. NOI $250,000 and the rate is 8.25. Easy. I over R equals $3,030,303. A property can produce $15,000 on potential gross rent each month. The annual potential gross rent multiplier is 6.5. What's the estimated value of the property? So 15,000 times 6.5 is 1,170,000. Calculate an effective gross rent multiplier from the following market data. Effective gross rent multiplier. So that is after vacancy and collection loss is taken out. Market potential gross rent is $140,000. The sale price is $891,800. The V&C is 9%. So we have $891,800. Subtract out the 9% from that, and then divide all that by 140,000, and we get 7 for our potential gross rent multiplier. Okay. So we subtract vacancy and collection loss from our PGR, and 9%, what I did here was a simple shortcut on the calculator, 140,000 times 0.91 to get 127,400. The reason I did that, 0.91, is the VNC loss is 9%, so 100% minus the 9% is 0.91. So you take your sale price, 891,800, divide it by 127,400, and you get a gross rent multiplier of, effective gross rent multiplier of 7. Given a discount rate of 8% and a recapture rate of 2.5%, what would be the land cap rate? Well, it's given in the problem. That would be 8%. Because it says, given a discount rate of 8%. Hope all the level 3 questions are like that. When calculating a value estimate through direct capitalization, which of the following would likely produce the most accurate estimate of property value? Net operating income divided by the cap rate. If the subject's improvements are worth $650,000 and have a remaining economic life of 50 years, what's the recapture rate based on the economic life straight line recapture technique? 650,000 divided by 50. Believe that's 2%. Oh yeah. 650,000 divided by 50 equals 13,000, and it wants to know the recapture rate based on the economic life straight line recapture. So it's going to be the same every year. So you take that 13,000, divide it by the 650,000, and you get 2% for the answer, which is correct. In appraisal, a discount rate tells you how much return a property owner receives through the income stream after you subtract expenses and the cost of recapturing the wasting assets. That's what a discount rate tells you in appraisal. You know that the building makes up 75% of the property's value. The building cap rate equals 15%. The land cap rate is 10%. What's the overall cap rate using band of investments? So, if the building makes up 75% of the property's value, well then the land makes up 25%. So, that would be 25% times 10% plus the 75% plus the building cap rate of 15%. So you sum the two numbers and you get 13.75% of the overall cap rate using band of investments. The subject property has a net operating income of $71,500. The property has a recent sale price of $650,000. What's the overall cap rate? Well, we use our IRV, and we do $71,500 divided by $650,000, and we get 11%. You are using traditional capitalization or direct capitalization to appraise a 10-year-old office building. On the operating statement, the property owner subtracts $140,000 spent to replace carpeting and repaint interior walls. What's a correct description of this expense? Well, the expense would be disallowed since a prudent owner would have built up a reserve to cover it, and the reserve replacement would be allowed. Then the reserve for replacement would be allowed. A reversion is a lump sum benefit an investor receives at the end of the holding period. You are appraising a property that produces potential gross rent of $150,000. The vacancy and collection rate is 10%, and the expense ratio, not including taxes, is 35% of the effective gross income. The tax rate for the year of appraisal is $1.25 per 100. The appropriate cap rate, not including taxes, hint, 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 need to load the tax rate, is what is the estimated property value? Well, I'm just going to tell you it's $797,727 because that's a lot to say without actually working it out and writing it. But you would take the PGR, subtract the V&C rate of 10%, so that would end up being $140,000 because you have $150,000 times 90%, and that comes out to $140,000. And then you're taking off the expense ratio, and then loading the cap rate, and you're going to come out with $797,727. You know that land makes up 20% of the property's value. The discount rate is 14%. The recapture rate is 5%. Use band of investment to develop an overall rate. Well, if land is 20% and we have a discount rate of 14%, we know that, and a recapture rate of 5%, we know that the building cap rate would be, or the building percent would be 80%. And we sum the discount rate and the recapture rate for the building, and that is 19%. So we have 20% times 14% equals our first number, and then we have 80% times 19%. And then we add those two products together, and we get 18%. You are appraising a property that produces a net operating income of $82,000. The overall capitalization rate is 12.5%. What's the estimated property value? Well, $82,000 divided by 12.5% is $656,000. You are appraising a property that produces net operating income before taxes of $95,000. The overall cap rate, not including taxes, is 12%, and the tax rate is $1.50 per 100. What's the estimated value of the property? So on this one, the answer is $703,704. If a property is valued at $1,250,000 and was capitalized at 12.5%, what is its net operating income? So we have rate times value in this case. So we come out with $156,250. The discount rate for a property is 10%. The recapture rate is 5%. The land to property ratio is 1 to 4. So 25% and 75% for built land and building respectively. The holding period is 20 years. Develop an overall rate using band of investment. So we're not doing yield capitalization here, even though it kind of threw that in. The holding period of 20 years, that doesn't really matter to the problem. So we get an answer totally of $13.75. And that's taking 25% for the land times 10% plus 75% for the building times the discount rate of 10 plus the 5%. So 15%. So 75% times 15%, and then we add those two products together and get 13.75%. You're appraising a property with a potential gross rent of $65,000 per year. Vacancy and collection losses equal 10%. The potential gross rent multiplier is 8.8. What's the property's value? Well, $572,000. All that matters in this problem is the potential gross rent and the multiplier. So 65,000 times 8.8. You are appraising a property with a potential gross rent of $100,000. The vacancy and collection loss is 10%. The management expense is 5% of effective gross rent. So $140,000 times 5%. Other expenses equal $36,000. Secondary income is $25,000. What is the NOI? The answer is $52,000. You got to watch where you deduct that other expenses and the management expense of 5%. It'll trip you up, because it did me. Had to work it 10 times to get that answer, but I got it. The value in the marketplace refers to market value. An easier question. The income approach to value translates the ability of a property to generate income into an indication of value. Okay, new section. Period of growth, stability, decline, and revitalization are all life cycles of a neighborhood. Which principle states that the value of a property derives from future benefits buyers would expect from the property? That would be anticipation. That sound of paper coming out are problems that would be impossible to describe on audio. There are some market sales comparable problems, and an RCN schedule, and yield capitalization, and a mortgage constant problem, which I can't even read the text because it's really small. Anyhow, so values in your market are declining at a rate of 1.5%. You have a $75,000 sale that took place 3 months after the date of appraisal. So what was the value? The question is, what is the sale price adjusted for time? But really the question means, what was the value on the date of appraisal, which will be January 1st. So $75,000 times 1.5% per month times 3, so that is 75,000 times 0.045. That comes out to 78,375. I think I could do that problem in my sleep. And an improved property recently sold for $100,000. The land component of the property is worth $25,000. That means the building component is $75,000. But what's the land to property ratio? Well, there's 4 parts. And you can find that out by taking $100,000, dividing it by 25,000. You can get 4. Well, you divide the sale price by the land component, and you can get the ratio for land to property. A property sold 1 year ago. Here's this problem again. I'll just read it, give the answer. A property sold 1 year ago for $64,000 and recently sold for $79,360. The monthly rate of appreciation is 2%. Another comparable problem. Properties in an appraisal district are appreciating at 2% per month. Here's this problem again. If a property sold 6 months ago for $60,000, what is its current value adjusted for time? Well, 6 months ago it was $60,000. Well, we're appreciating at 2% a month. So 60,000 times 2% times 6, so 12%. So 60,000 times 1.12 will give you the appreciated value. Learn that little trick. It's 1 or 2 less calculator steps. 60,000 times 1.12. It's kind of like that retail markup method in the BPP. Building to property ratio in an area is 4 to 5. A single family residence sold for $125,000. What's the land value? Well, if there's 5 parts, they're 20% per part. So 125,000 divided by, or times 20%. Equals $25,000. And it will always equal $25,000 if you punch the numbers in right on the keyboard, on the calculator. You know that the typical land to property ratio in the subject neighborhood is 1 to 5. You have appraised and improved property at $130,000. What's the land value? Well, 130,000 divided by 5 gives us our value for the 1 part, and that's land. It's $26,000. The percentage of overall changes in a time adjustment equals the amount of price change divided by the earlier sales price. Okay, new section. The appraisal phase of a tax calendar is from January 1 to May 15th. The collection phase of a tax calendar begins on October 1st. The equalization phase of the tax calendar is from May 15th to July 25th. The assessment phase of the tax calendar is from July 25th to September 30th. The deadline for filing most property tax exemptions is before May 1st. Before May 1st. That's according to the text. The delinquency date for property taxes is February 1st. Business personal property rendition due date, if no extensions are granted, is April 1st. Date the records are submitted to the ARB is May 15th. Date for the ARB to approve records by is July 20th. Property owner protest deadline, if notices are mailed out timely, is before May 15th. But in reality, The protest deadline for a property owner to protest is 30 days after the mail date of the notice. But by the book, it's May 15th. Certification of the appraisal roll date in most counties is July 25th. The property tax code section that requires reappraisal of real and personal property at least once every 3 years is tax code section 25.18. Tax rate adoption date deadline, if certified roll was received timely, is September 30th. Deadline for a taxing unit to file a challenge is June the 1st. Property tax code section that mandates the use of USPAP is tax code section 2301. Property tax code section 2519 sets forth requirements for the notices of appraised value. Property tax code section that deals with exemptions is section 11. Tax code section 23 deals with appraisal, and tax code section 25 deals with the preparation, correction, and certification of records. Tax code section 41 deals with the appraisal review board hearings. Tax code section 41 deals with the grounds for taxpayer protests or a taxing unit challenges. Tax code section 2525 deals with corrections to prior year's roll or substantial errors of 1/3 over. Value of 1/3 over if it's that much over. It's a 2525. One of the weaknesses of the comparable sales approach is that it requires an active market. One of the strengths of the comparable sales approach is that it reacts directly to the market. Strength of the income approach produces a value estimate based on a special use identification, agricultural or timber. Weakness of the income approach is that property must be able to generate an income stream. Strength of the cost approach is that it can be used to produce a value estimate for any type of property. Weakness of the cost approach, it requires either market or income approach to value land. The formula for calculating tax on a single property is tax rate times taxable value. Really hard. What is the formula for calculating the taxing entity tax rate? That would be the tax rate equals the tax levy divided by the total taxable value times 100. What's the formula for calculating the taxing entity tax levy? That would be tax levy equals the tax rate times total taxable value divided by 100. What's the formula for a time adjustment, overall percentage of change on a property that has sold twice? That would be current sale minus earlier sale divided by the earlier sale price, like that problem we saw 300 or 400 times. The subject property sold X months prior to the date of appraisal. The market is appreciating at X percent per month. What's the formula for calculating the change factor? That would be the monthly percentage change times the number of months equal the change factor. The subject property sold X months prior to the date of prior to the date of appraisal. The market is appreciating at X% per month. What's the formula for calculating the adjusted sales price? Monthly percentage change times the number of months equal the change factor. Well, change factor plus 1 times the sale price equals time adjusted sales price. Kind of like the retail markup method in BPP. Uses the same idea. Using the income approach, the income part of the formula, to figure income, you get rate times value. To figure the rate, it's income divided by value. To figure value, it's income divided by rate. Which of the following are the components of the discount rate? That would be safe rate plus risk rate plus non-liquidity rate plus management rate all make up the discount rate. Which of the following is not a formula for potential gross rent? It's not. This is not a formula for potential gross rent. Gross area times economic rent less V&C. We would not be concerned with V&C in PGR. What is the formula for calculating the EGR? Potential gross rent minus the V&C losses. What is the formula for EGI? PGR minus V&C plus secondary income is effective gross income. What is the formula for NOI? PGR minus V&C plus secondary income minus allowable expenses. What is the formula for the loaded land cap rate component? Discount rate plus effective tax rate. What is the formula for the loaded building cap rate component? Discount rate plus recaptured rate plus effective tax rate. What is the formula using the band of investment method using discount rate and recapture rates? Land percentage times discount rate plus building percentage times discount rate and recapture rate. What is the formula using the band of investment using first and second mortgages components and the equity component? First mortgage times mortgage cap rate plus second mortgage percent times mortgage cap rate plus equity percent times equity cap rate. What's the formula for GRM? Sale price divided by gross rent. What's the formula for potential gross income multiplier? Property value divided by the potential gross income. Which PGI is also PGR. The text said it's interchangeable. Formula for net operating income. Property cap rate times property value. When are the tax statements mailed? October 1st or as soon as possible thereafter. When are the taxes due? Upon receipt of the tax statement. When do the taxes become delinquent? February 1st. When is the additional penalty for delinquent attorney attached on real estate? July 1st. How much is that additional penalty? Up to 20% for the penalty for delinquent attorney fee. Which entity is required to offer mandatory homestead exemption? That would be the ISD, the school. How much is the mandatory exemption for ISDs? That would be $25,000. How much is mandatory age 65 or older exemption and disability homestead for ISD in addition to regular homestead? $10,000. Which two Wise County ISDs offer local option percentage exemptions? Okay, you're only going to know this if you live in Wise County, and this is Mickey's personal tests for his, appraisers or employees, but that would be Bridgeport and Slidell. So scratch that. Shouldn't even have read it. If a homeowner's market is $100,000 and they qualify for state mandatory regular homestead exemption, what is their taxable value if no local exemptions are granted? Oh, $75,000, because you subtract the $25,000 mandatory, because they qualify for state mandatory regular homestead exemption. The last day for property owners to file most exemption and special appraisal applications is April 30th. A property owner may file an age 65 or older exemption application up to 1 year after the date on which he or she has become age 65. Did not know that one. A property owner may file a homestead exemption up to 2 years after the date the taxes become delinquent. A property owner may file a disabled veteran exemption up to 5 years after the date of taxes becomes delinquent. The deadline for property owners to file most protests with the ARB is May 15th or by the 30th day after the notice of appraisal is delivered. In addition to owning property on January 1st to qualify for homestead exemption, what else must the property do? Well, they have to live in the property. What must the taxpayer provide along with the homestead forms to qualify? A driver's license. Surviving spouse can qualify to continue aged over 65 exemptions from spouse if surviving spouse is 55 and older. Last two questions. Mr. Smith and Mrs. Jones have both lost their spouses and decide to get married. They move into Mrs. Jones' home. This is tricky. Mr. Smith and Mrs. Jones both lost their spouses and they decide to get married. But they move into Mrs. Jones' home. What happens to the exemptions on Mr. Jones' home? The exemptions must be removed because the couple can't claim both. So the taxes on Mr. Jones' property is going to go up. He should sell it. Mr. Smith, age 68, and Mrs. Jones, age 58 but disabled, are getting married. They will live in Mr. Jones' home. Can they claim Mrs. Jones' disability in addition to Mr. Jones' age over 65 exemption? No, because it is Mr. Jones' separate property prior to the marriage, and no, because they can't qualify for both. Interesting rule. And that is it. The end of 5 cajillion questions. Quia questions.